Welcome to this week's podcast. My name's Andrew Wilkinson with Interactive Brokers. I'm joined by my colleague, Jeff Praisman. Hi, Jeff.
Hey, Andrew, how are you?
I'm doing all right, mate. And I would like to welcome to the program Stephen Hatzakis, who's the Global Director of Online Research at forexbrokers.com. Welcome, Stephen. How are you?
I'm well, thank you. Thank you so much for having me, Andrew.
It's going to be a great discussion. We're going to be talking about foreign exchange, currency rates. Just give us some insight into your role at forexbrokers.com, Stephen.
Absolutely. I joined forexbrokers.com in 2016. Our parent company, Rank Media Group, owns multiple properties, including stockbrokers.com, investor.com. And I was hired to lead the research in online broker reviews. We're constantly testing brokerage platforms, such as from companies like Interactive Brokers. And in addition to being a partner, I'm writing content and experimenting with the latest technologies from companies that are in the online brokerage industry.
Very good. Okay. So first of all, Steve, I'd like you to give the audience some idea as to the overall size globally of the foreign exchange market. And perhaps if you can, to discuss a little bit about whether there are certain regions where retail or institutional traders dominate the space, please.
Absolutely. That's a great question. The foreign exchange market is the largest market in the world. So it trades upwards of $7.5 trillion in daily average volume. That's according to the latest data from April 2022, which was the last triennial survey from the Bank for International Settlements. So to put this in perspective, 7.5 trillion in daily volume, that's greater than the stock market and commodities markets combined on a daily basis. So it's really a massive market. All the global currencies in the world trading electronically for the most part. There's also some voice brokerage trading, but the market is highly efficient. It's one of the largest. It is the largest market in the world. And there's another report coming out in a few months, actually, because this is a triennial survey. So I'll be interested to see if that number is going up, because it has been for the past 10, 15, 20 years. The market has been growing consistently.
Hey, Stephen, it's good to see you again. What is attraction to traders and what are they using it for?
I wanted to add on the question of where the market is developing, because I think that affects how traders use it. So I would say that you're either speculating or using it because you need the money. Let's say purchasing a property abroad, or maybe you're a business and you have an import and you have to pay an invoice overseas. Depending on the need of the investor or user, that's going to dictate why you're using it and also where you are geographically. Here in the US, for example, we think in dollars because that's what we're transacting. But if you're importing a product from Europe and that you have to settle in euros, then you can be exposed to the Euro USD exchange rate. And that could cause your purchase to cost you more money than you anticipated. Or if the currency moves favorably for you, it can end up being cheaper. So you can either hedge that currency exposure using different instruments such as spot Forex or options or futures. Or if you're an investor and you just want to speculate and take a position because you think the euro is going to go up or down, then that can also be a way to, potentially make a profit or a loss, depending on if the market moves in your direction or not.
And Steve, I think you touched on it with your answers to the prior questions a little bit, but could you dive deeper into who is actually trading FX? Because it seems to me like there's maybe several different parties that are.
Absolutely. So the foreign exchange market has different type of participants. You have retail traders, you have professional investors who can be corporations or even institutional investors, which will be larger companies and potentially hedge funds or other funds. And the needs of each trader can vary for sure. You also have central banks who are the largest players that are effectuating monetary policy. That could be a central bank of a country that's coming in to purchase or sell its own national currency against other currencies and transact with other central banks, or even transact with local banks that are purchasing on its behalf. So that's usually the spectrum of traders that you have. You have non-bank intermediaries, institutions, central banks, and then you have retail traders, which are individual investors.
Stephen, now maybe I'm going back a little bit, and maybe I'm showing my age a little bit here, but we've heard of Mrs. Watanabe. She's also known as the kimono trader. Is she as important now as she was in the past? Does she still exist?
I think that term has evolved over the past couple of decades. Japan has historically been very strong for foreign exchange volumes, but that actually changed recently when Singapore basically usurped it and came into the second position, I believe, after the US. I'm sorry, after the UK. So you have the UK, you have the US, and then you have Singapore. So in Japan, you still have a tremendous amount of volume, and the term was popularized because you had everybody there trading, housewives, everyday people. And that's how this catchphrase term evolved to represent the Japanese retail trading market, which was very strong. The volumes coming out of retail traders in Japan were orders of magnitude larger than the typical volumes you would see in other countries from a normal demographic. But I think it's still important, but not as important as it used to be. The market has grown, it's evolved, it's more efficient. So the trades from a retail trader or even a group have less an impact now than they did back then.
And you mentioned just with your explanation of where that term Mrs. Watanabe came from and how Japan, so many different types of traders are trading. How are, in this modern day, how do they access the different markets?
Market access is always important because you have a lot of new market entrants coming in and people that are just learning about Forex for the first time. So it's important. Obviously, they choose a broker that's highly regulated. But once you have that choice and you're looking at how to trade it, there are different ways you can approach it. Spot trading, I would say, is one of the more popular ones for retail traders. It does represent a significant portion of the foreign exchange volumes as well. Even though the retail side is smaller, that is still typically the number one way because you're trading on the spot and it's pretty straightforward. Futures can be, I think, a little more complex, but they still have their place and they've evolved. They've become more accessible. They used to be standardized and the contract sizes were not as flexible, but now you have different size futures contracts. So it's leveled the playing field between spot trading and futures trading. They're both traded from a margin account. There is leverage and the possibility for greater risk there, along with greater reward. But you need to be really careful when choosing the instrument. And then options is another type of instrument that can be used by traders, but that's also complex and not for everybody because they have that time value, which is decaying. So all options expire worthless eventually as that time runs out. And if you don't exercise them in the money. But those are the three popular ways I would say: spot, futures, and options. There are other
Mhm.
ways you can trade, such as swaps and forwards, but those are usually not traded by retail. Those are more typically institutional products.
Yeah, and I would imagine too, just staying on the subject a little bit, that maybe particular products might be favored by some classes of investors versus others. Maybe with institution liking kind of everything, but retail might be guided toward one, like you said, the spot FX versus the more complex currency futures or currency options.
Right. And it
Uh,
depends on the strategy as well, because you could have a retail trader that might use a blend of those products. They might have a more sophisticated strategy. They might be more experienced. So they might want to combine some of those instruments as part of a more advanced, risk management strategy or approach to the market.
mm. And it's interesting too that there are so many products because I think a lot of people that aren't familiar with forex trading, they might just really think of the spot, right? That's the intuitive way. Oh, I'm thinking I'm going to buy some Great British pounds, or I'm going to buy the euro. Whereas there really is multiple asset classes, multiple instruments, I guess they can use. But one thing that comes up sometimes that you read about is the majors versus cross currency pairs. And could you explain to our listeners that because it's maybe not super intuitive for someone who's not familiar with Forex. Could you explain the difference between the two?
Absolutely. So you have major currency pairs that represent usually the biggest economies. They're the most popular traded pairs. We think of the US dollar, the euro, the British pound, the Swiss franc, the Japanese yen. So when you take those currencies and you price them against the dollar, the US dollar, we consider those to be the major currencies. But now let's say you wanted to price the euro against the pound. Now it's still there's still two major currencies involved there, but that's technically a cross pair. It's entirely deterministic. And a lot of people don't realize this, but the way you calculate the British pound against the euro price is by taking those two underlying currencies against the dollar. So you'll have the British pound against the US dollar, and then you'll have the euro USD. And using a math formula, you're able to multiply them and get the deterministic calculated rate for the euro GBP. And it's the same approach for all the cross pairs. So sometimes you have to multiply, sometimes you have to divide. It depends on which side the US dollar is on both of the pairs in the equation and whether the rate is below one, such as the Australian dollar versus the yen. There'll be division there. But the point is that there's a math formula where you can calculate all the crosses using the major currencies. They're entirely deterministic. And why is this relevant for traders? Because if you're looking at, let's say, the British pound against the dollar, and you're also looking at the dollar against the yen, then obviously those two majors are going to affect pound yen, which is the derived cross. And if you see, let's say, a 3% move in the pound and a 1% move in the dollar yen, then the pound yen will move by 4% if the two underlying went up, because it's the sum of their movements if they both moved in the same direction. If they both move down, though, then that would amplify to the downside the pound yen. Whereas if they offset each other, then you could see a 1% rise in one, a 1% decline in the other, and the pound yen could stand still. But obviously, when this takes place, it's more linear and not just suddenly the markets, but sometimes the markets move suddenly as well. But the point is that this is why it's important to traders, because they may be looking at these different currency pairs and how they affect each other and trade the crosses as a way to get exposure to certain pairs without getting exposure to others.
So they really, with the currency pairs, is really just more moving parts to keep it simple, right? There's just more inputs just by definition.
Yes, and not to overcomplicate it, I would say that a simpler way to think of it is these are all ratios, right? If you're when we buy things in the US, we think of dollars. How much does this cost in dollars? When you're buying currency, you can also think in dollars. How much do these euros cost in dollars? How much do these yen cost in dollars? And so it's just changing the base currency from dollars to other currency. How much does the euro cost in yen? How much does the Australian dollar cost in pounds? So it's really just knowing what the underlying currency rate is in order for you to know what the price is of whichever pair you want. Just if you were to price shares of a stock, we could think of Microsoft or Tesla or any stock priced in dollars, but we could also think of one stock price in another stock. And that's how Forex is. It's a ratio of one price to another. So I hope that helps add some clarity on this for our listeners.
Yeah, no, definitely. Definitely. I think that was a great explanation. Really, I think it really put it straightforward what the differences are. So what are the factors that drive the currency market then? And how does someone go about understanding the equities, right? Like, okay, earnings, financials, currency is a little bit different, right? So what are the factors that really play into the movement of those markets?
Yeah, that's a great question. And for people that are just starting out, this is the basic 101 that you really want to know, because the foreign exchange market is influenced by a number of factors, but primarily it's the economic and monetary policy from each country. So their central bank, their monetary policy. There's other geopolitical aspects of a country that can affect the value of its currency, but primarily you're looking at the economic events. So you'll think of an economic calendar, and it has all these calendar events from these events that are happening in different countries around the world. And if you look at an economic calendar, you'll see that there's almost an endless array of news coming out across the world throughout the trading week each week. And traders look very seriously at those events. Some are more important than others. Some may have a larger impact than others. Figures like GDP, non-farm payroll, I can go on and on. Traders are looking at these numbers because if it's higher than the forecast or worse than the forecast, that will impact the market one way or another, depending on what the consensus is. So those are the main drivers, in addition to supply and demand and what the market is expecting. Those economic indicators and monetary policy and other geopolitics are really what drives the value of one currency to another.
Yeah. Now, Stephen, you've done a lot of surveys in your time. From your side of the fence, what are some of the favorites or more suitable indicators and tools that retail traders look at to get involved with FX trading?
Tools have certainly evolved over the years, and what a retail trader coming into this now has access to, there's certainly a lot to choose from. That's no guarantee of success. You shouldn't rely too much on one particular tool, but it's good to use a series of tools in your arsenal to help form your opinion on your market outlooks. And I think some of the popular tools can fall into one of several categories. You have technical analysis on one, and then on the other side, your basket of tools can include things like fundamental analysis, which ties back to the economic calendar events and news that we spoke about. Fundamental analysis could be some reporter's opinion or someone you hear on TV. It doesn't always have to be an economic calendar event, but the whole spectrum of that fundamental news analysis and analyzing the numbers related to the economy, that's going to be the fundamental analysis. So there's a lot of tools that you can find in your typical brokerage trading platform software related to fundamental analysis, news headlines, articles, etc., with analysts covering those fundamental aspects. On the other hand, the technical analysis is more devoid of fundamental data. It's purely just using a math-based approach on the data from an analysis perspective, whether you're looking at a moving average, whether you're looking at a Fibonacci retracement, you're measuring something with a fancy tool, or maybe it's a simple tool, maybe it's a 200-day moving average. So it can be a complex indicator, it can be a simple indicator, but at the end of the day, there are hundreds of these indicators. And again, you shouldn't rely too much on any one of them, but use them in conjunction with your broader perspective to try to gauge what's happening and make sense of the market. But technical analysis has its place, I believe, even regardless of your belief in the efficient market hypothesis. There are different views. Some view them more strongly than others. But the point is that when we look at the history of the price, there could be some clues there that are statistically significant. Usually you need at least a certain period data points, whether it's 16 or 17 periods of data, whether that's on a minute chart or a monthly chart or weekly, regardless of the time frame. Once you have enough quality data points and you analyze them, they're no prediction of the future. Again, it's not any indication of what's going to happen other than a possibility. So it can be pointing in one direction, it could be pointing in another. But it's just one of those tools where, again, you don't want to rely on it too much, but it gives you an idea on what could be possible and statistically significant in terms of analyzing the historical price to try to determine where it could go in the future. But again, nobody knows. Nobody has that crystal ball and there's no magic indicator. And that's important for everybody to realize in case ads online or whatnot, where things could get overhyped.
My final question to you is, what is in vogue over time in terms of major crosses? Which currencies?
Well, it's changed over the years. There's a cost to trading the crosses because the spreads are usually higher because you're basically taking the spread of the two underlying and you're combining them because you're trading something that could be more volatile than its underlying component. So there is, again, if you're trading a cross pair in Japan where interest rates were lower, that's one of the reasons why the traders were so strong, because they were able to borrow locally and invest in other countries known as the carry trade to capture the interest rate differential. And while the carry trade is not as popular nowadays because interest rates have been rising globally, you still have these type of qualities that you're going to look for to determine which currency pairs you want to trade, whether it be interest rates, whether it be volatility, whether it be positive or negative data coming out of a specific country. Because unlike stocks where a lot of times traders are thinking which stocks to buy to go long. In the FX market, whether you're going long or short, it really doesn't make a difference. It's not like the stock market where you have to think about borrowing the stock in order to short it. With Forex, there's always two sides to the trade. You're always buying and selling two currencies when you do a Forex trade. If I want to buy the Euro USD, then technically I'm buying the Euro, selling the dollar, or vice versa. So because of that, the short answer to your question is it really depends on the market conditions and what the trader wants to do. But I think there are opportunities across all the pairs, whether it's a major pair, cross pair, or more exotic pair. Obviously, you'll have more risk with the more volatile pairs, but you can see volatility in major pairs as well.
Stephen Hatzakis from forexbrokers.com. Thank you very much for joining us today.
Thank you so much for having me.
And Jeff, thank you for co-hosting.
My pleasure. Great seeing both you guys. Looking forward to our next one.
And to the audience, thanks for taking the time to listen. And remember that you can subscribe to this channel wherever you download your podcast from. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. There is a substantial risk of loss in foreign exchange trading. The settlement date of foreign exchange trades can vary due to time zone differences and bank holidays. The interest rate on borrowed funds must be considered when computing the cost of trades across multiple markets. Trading on margin is only for sophisticated investors with high risk tolerance. You may lose more than your initial investment. For additional information regarding margin loan rates, see ibkr.com/interest. Futures are not suitable for all investors. The amount you may lose may be greater than your initial investment. Before trading futures, please read the CFTC risk disclosure. A copy and additional information are available at ibkr.com. Options involve risk and are not suitable for all investors. For more information, read the characteristics and risks of standardized options or OD, which may be accessed through the link found in the podcast description page.